Welcome to BYDFi. I'm Elisa, your guide for this Bitcoin course video series. What is DeFi? Can you use it to earn interest in your cryptocurrency holdings? Is it risky? And could it really change the future of finance as we know it? Stick around, because on Bitcoin courses, we will tackle these questions and more. Before we begin, don't forget to subscribe to the channel and click the bell so you'll immediately get notified when a new video comes out. Let's get started. Today's topic is decentralized finance, or DeFi for short. If you've watched our previous videos, you already know that Bitcoin is a form of money that isn't controlled by any central bank or government. It can be transferred globally from one person to another, all without needing a bank or financial institution. Bitcoin is decentralized money. If you're just starting out, you might want to check out our What is Bitcoin video to get up to speed. However, transferring money is only one of many building blocks in any financial system. Besides sending money to one another, we rely on various financial services in our daily lives: loans, savings accounts, insurance, stock markets, and so on. Together, these create a complete financial system. Today, our financial system, and all its services, are centralized. Banks, stock markets, insurance companies, and other financial institutions are all operated by organizations or individuals in charge of delivering these services. This centralized financial system, often called DeFi, has risks such as mismanagement, fraud, and corruption. But what if we could decentralize the entire financial system, just as Bitcoin decentralized money? That's exactly what DeFi is all about. DeFi is a term given to financial services that operate without any central authority or person in charge. Using decentralized money like certain cryptocurrencies, which can be programmed to perform specific activities automatically, we can build exchanges, lending platforms, insurance companies, and other organizations that have no owner and aren't controlled by anyone. Feeling confused? Don't worry, we will break it down. To build a decentralized financial system, we first need an infrastructure for programming and running these decentralized services. Fortunately, Ethereum does just that. Ethereum is a do-it-yourself platform for creating decentralized applications, known as dApps. Our What is Ethereum video explains Ethereum in detail, but for now, we will just say that with Ethereum, we can write automated code, called smart contracts, that manages any financial service we want in a decentralized manner. This means we define the rules for how a service will operate, and once these rules are deployed on the Ethereum network, they're set in stone. We can't change them, they're immutable. With Ethereum providing the groundwork, we can begin constructing a decentralized financial system. The first thing any financial system needs is, of course, money. You might be wondering, why not use Bitcoin or Ether, Ethereum's currency? Well, while Bitcoin is indeed decentralized, it offers only basic functionality and isn't compatible with the Ethereum platform. Ether, on the other hand, is compatible and programmable, but highly volatile. If we're looking to build reliable financial services that people will use, we will need a more stable currency for transactions. This is where stablecoins come in. Stablecoins are cryptocurrencies pegged to real-world assets, typically a major currency like the US dollar. Our video, What are Stablecoins, covers how stablecoins are created and the different types of pegs in more detail. For DeFi, we prefer stablecoins that don't rely on fiat reserves, as those would require a central authority. Enter DAI, a decentralized cryptocurrency pegged to the US dollar, where 1 DAI equals $1. Unlike other stablecoins that are backed directly by USD reserves, DAI is backed by crypto collaterals viewable on the Ethereum blockchain. DAI is over-collateralized. This means that if you deposit $1 worth of Ether, you can borrow 66 cents of DAI. When you want to retrieve your Ether, you simply pay back the DAI you borrowed. If you don't have Ether to use as collateral, you can buy DAI on an exchange. DAI's decentralized nature is due to its existence as a smart contract on the Ethereum platform, making it a trustless, censorship-resistant stablecoin. It can't be shut down, making it an ideal currency for DeFi services. With stable, decentralized money in our decentralized financial system, we can add more services. The first major service is a decentralized exchange or DEX. DEX is run on smart contracts with rules that let users buy, sell, or trade cryptocurrencies without central authority. Like DAI, they operate on the Ethereum platform, meaning they have no operator, no signups, no identity verification, and no withdrawal fees. Trades are executed through smart contracts that secure funds when necessary, eliminating the need to store funds in exchange accounts. Security benefits over centralized exchanges. And DeFi doesn't stop at exchanges. Now, let's look at decentralized money markets, which connect borrowers with lenders. Compound, for instance, is an Ethereum-based borrowing and lending dApp where you can lend your crypto and earn interest on it. If you need cash but only have cryptocurrency, you can deposit it as collateral and borrow against it. Compound smart contracts automatically match lenders and borrowers, enforce loan terms, and distribute interest. Yield farming, the effort to generate maximum returns by putting crypto assets to work, has grown popular as a result of these decentralized interest-earning options. DeFi doesn't stop there. Now, let's explore decentralized insurance. Just as traditional financial services include insurance, DeFi offers insurance as well. This allows users to insure funds through decentralized platforms that connect users willing to pay for insurance with those willing to provide it, all without needing an insurance agent. The beauty of DeFi is how these services combine, like Lego blocks, allowing endless creative possibilities. For example, you can start by using a DEX aggregator to find the best exchange rate for swapping Ether for DAI, lend the DAI to earn interest, and add insurance to cover potential risks. This system brings many benefits: transparency, interoperability, decentralization, flexible user experience, and inclusivity. However, DeFi is still young, so there are risks. In the past, smart contracts have had vulnerabilities, and hackers have exploited loopholes. If you're new to DeFi, start with small amounts of money you can afford to lose. Also, remember that a system is only as decentralized as its most central part, so some DeFi services may retain centralized components that could act as weak points. It's essential to understand each service before you invest to know any potential issues. To sum it up, the DeFi movement is in its early adoption stage, but it could revolutionize finance, opening access to millions who face high fees or financial discrimination in the traditional system. That's it for this episode of Bitcoin Courses. Hopefully, you now have a better understanding of what DeFi is, a system of decentralized financial services that aims to replace our current centralized financial structure. If you still have questions, drop them in the comments. And if you want to explore some popular DeFi projects, check out the list in the video description. If you have questions, feel free to leave them in the comments below. If you enjoy the content, please hit the like button and subscribe for updates on new episodes. Thank you for joining me on the Bitcoin Courses of BYDFi. I'm Elisa, and I will see you soon.